Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Merryn Talks Money News Roundup, where we talk about the biggest moves in the markets this week and what's driving them. I'm John Stepek, Senior Editor at Bloomberg and author of the multi-award-winning Money Distilled newsletter. Joining me, as usual, in Merryn's absence is friend of the show, Marcus Ashworth. Marcus is a Bloomberg Opinion columnist with a deep expertise, it says here, in European markets, but I would extend that to bond markets and markets generally. And yes, as we all know, he's a regular contributor. So, nice to have you back, Marcus.
My pleasure, as ever.
It's actually been quite a hectic week this week already, and it's only Thursday morning.
Well, we do have obviously sharp moves in things which have been going anything but up. Finally, we realised that they can actually also stop going up and even go down a bit.
So this was interesting because just before, when you had a piece out last week basically saying that the kind of debasement trade,
I think was the exact words you're looking for.
Almost.
Rather magnificently. Better be lucky than clever.
To be fair, you said the debasement trade was basically a made-up story. Is that reasonable?
Well, I mean, there's some foundation, like anything. There's always some semblance of truth in the fact that governments do need to learn how to cut spending or certainly reduce the increase in it. But to try and extrapolate that across that the dollar is over and that only thing you can have is crypto and indeed gold, I thought was just a little bit too much for me.
Yes.
This was a great trade, which is everyone seemed to think it was a momentum trade and would only ever continue going up. And we just found the limits of, it's still doing extremely well. And that will continue to do very well, but just need a bit of a health correction. So
yeah, a bit of a breather at least. Yeah, it has been looking quite toppy.
It's gone parabolic
a little while.
Right above, sort of, it's gone up so fast that it literally, and there isn't any real reason, I think, for it to be quite so sustainable. But there we go. Nice to see things like silver and palladium and platinum and all the mining stocks finally catch up. But funny enough, that's when that happens. That the end is near. But I certainly think gold has got some validity. And the thing is, people don't really sell gold. That really want to hold gold. They keep on holding it. Yeah. Central banks and individuals alike. Having said that, there was clearly far too much leverage and retail momentum going in it, and that just needed a bit of a health check. So I'm probably healthier for it. Yeah,
and it'll be interesting to see how that continues because, the other thing that I don't know, again, I'm sure you've noticed this, but maybe in the last month or so, there's been a real turn in the bond market. It's kind of gone from being, ever higher yields to a sort of sense that maybe yields are high enough now that they're attractive, particularly if inflation is coming down.
You look at 10-year gilts, they're 50 basis points off their highs. You look at 2-year gilts, they're 90 basis points off. But this is driven principally by Jay Powell perhaps realising that there is actually some reason to lean on the employment side of his mandate and can cut rates. I expect them on Wednesday to do two things. One, which is lower again by 25 basis points, and more importantly, stop all forms of quantitative tightening.
And this is the Federal Reserve,
just to be clear. Pardon me, to make that clear. And I think they'll do the same again and cutting in December. There's a risk they might do 50 basis points on these points, but let's just say they cut by 50 basis points by the end of this year. That's going to put a lot of pressure on Andrew Bailey and co, who would be then 50 basis points above the Fed and see not just doing quantitative tightening, but active and passive. So I think there will be some pressure on them to do something about it. And that's really reflected now in two or three bits of data. Principally, labour market data is showing that pay expectations and pay levels are starting to come down, and principally in the private sector. The only thing that's keeping up, ironically, is public sector bonuses, but let's not go into that for now. The point is that what they need to see, and they do want to see, is private sector wage levels down to around 3.5%, which is starting to happen, and quite clearly. So, and then we had CPI, which was really, at 3.8%, people might think, what's the big fuss, because it was 3.8% the previous month, but the key thing is we expect to go to 4, possibly even higher, and that was going to be probably the peak. The fact that we've seen probably quite clear signs, being a bit brave here, that we've seen the top in inflation in the UK. That means in October, we're going to see a bunch of stuff coming off, particularly on energy prices, that just the way the basis works. So we should get 0.2 off next month anyway. That's just the energy effect. It's quite possible in the budget on November 26th that Rachel Reeves finally learns a lesson that she needs to get out of the way of the Bank of England and stop doing stuff which pushes inflation up, e.g. minimum wage rises, civil service pay rises, and of course national insurance on employers, which has really contributed to a lot of food inflation, because it's the cost of delivery of food, not the underlying commodity stuff that's been driving it up. That's rippled throughout the economy. But the point is that she can get, perhaps one latest thing to maybe make Mr. Miliband happy is that they reduced the VAT level on energy from 5% down to 0. It's a complete con, and we're all just being tricked by it. But it will lower inflation quite noticeably, which means we should be down to below 3%, into the 2.5s by the early part of next year. Could mean the Bank of England could cut as early as December maybe. Means one bank is calling for November, a bit bold, but one or two now starting to call for December, and I think certainly by February. They like doing on their quarterly things. I don't think they'll move in November, their quarterly meeting, but they will certainly tee things up, possibly in December for a cut in February.
I mean, the tricky thing is, I think that's a really good point about Rachel Reeves, and she's going to want to do what she can to avoid the annual April bump in inflation.
At last.
Which is basically, Simon French over at Panmure has been making this point for a while. The UK... Cleverly, the UK standout, the outlier status is basically all based on that indexation moment in every April, where the kind of prices go up and then that kind of ripples out for the rest of the year.
Well, it really did this year.
Yeah,
and she made it a lot worse. And that's going to take a while to filter through. But we do pay the Bank of England, there's lots of them, to work and see through these things. So yes, that they, everyone's saying, they can't cut because inflation's going higher. Well, in the US they can, and I think the US leads, and I think Bank of England will follow, and they won't want to leave too much of a gap. So I expect and hope that some of the data has come through, which is actually quite worrying on the economy, putting that aside, but certainly the inflation is probably, we've seen the worst of it.
Yeah. It'll be interesting to see what Rachel Reeves then does, because presumably that will also rule out, or rather a focus on inflation will rule out some of the things that have been talked about, like equalising VAT up the way. She's not going to put VAT up on anything, because that would push prices higher, presumably.
I'm giving you a Paddington stare when you mention things like this. I certainly hope not. Yes,
you don't want to give her any ideas. Okay, let's park that for just now. And the other big thing this week, which I feel this always goes slightly underreported, because Japan is the world's fourth largest economy still, and kind of like one of the most important developed markets. But it just got its new prime minister, who is sort of seen as an heir to Shinzo Abe.
Yeah, I think that's slightly oversaid, because she doesn't have anything like the freedom that he did. Obviously, twice he was prime minister, but and the three arrows of the Abe reform were never really fired very well. Certainly the last, in the sense of overall reform of. But there are some great signs.
Come through slowly.
No, definitely. And the Tokyo Stock Exchange in particular have done some really rather impressive things, and that I think it's still. I've long had Japanese stocks, having lived there and been doing Japanese equities and convertible bonds for many years. I definitely still believe and think there is a lot of reform to come through, and that the stock market will continue to rise better than most. So I still believe in it. I just don't think necessarily we should expect too much. This is Japan after all, and she's not going to be allowed to do too much, but certainly she's going to talk, and that's at least optimistic. And I think that the Bank of Japan will probably raise interest rates at some point, but they're not in a rush. Absolutely not in a rush, because I still don't think they feel, rightly so, that the whole deflationary aspect of many decades has gone away from Japan, and it can quite easily reassert. So in that sense, we will get slightly higher rates, still going to get higher bond yields probably over time. But this is all normalisation, ever so slowly, taking ages, but it should, I hope, continue to see some economic strength, and indeed reflected in the stock market in Japan.
Do you get any thoughts on, because obviously the Nikkei and the topics have both hit record highs. But have you any thoughts on the yen? Because obviously we're talking primarily to UK investors here. So you're buying in pounds. A lot of your kind of gains are being kind of dented at least by this kind of weak yen.
I mean, you can hedge it, obviously, but the point here is,
but then that's
the yen it's a tricky one to call. It could go either way really quite very quickly, and everyone's aware of that at the moment. It's sort of held quite sort of carefully versus the dollar. Certainly, I don't think sterling's going to do desperately well for the next 2 or 3 months because of
interest
we've
rates
outlined. And interest rates and also the economy is starting to turn a little bit as well. But in yen terms, look, as far as I see, I think the yen could and should weaken, but it really does have one of those things. When it trends very quickly, and the rest of the time that they do try to keep it boxed in, and I suspect the Bank of Japan will be very careful to do as much as they can, and the Ministry of Finance as well, to keep it that way.
Oh yeah, I suppose at 153 to the dollar, that's quite. How much weaker can it comfortably get before they start to worry about it?
Well, they worry about it all the time. So it can, certainly can get down through 160 and all that sort of stuff. I mean, I just don't know. It's the honest answer. I really don't know. It can go one of the other ways. Yeah. And anyone tells you they do know, again, I think is probably lots of bad things can happen.
So hedge half.
Yeah, well, that's not a bad way of looking at it, actually, exactly. I mean, I think, there's some optimism. And one thing I would note is that if you're thinking the US stock market is both topping and indeed that domestic US monies will look at overseas, Japan is a very keen and an obvious place for it coming. European bank stocks, a lot of Japanese, both tech and other sides, they are hedge funds funds are very familiar with investing in Japan over the years. It's a natural first place for them to go, and I think you're already seeing that. A lot of money coming out of the States. Where would it go? It would go to Japan, probably one of the top priorities.
Great. Thanks very much, Marcus. Appreciate your time as always. Thank you for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts, and keep sending questions or comments to merrynmoney@bloomberg.net. And you can also follow me and Marcus on X. I'm at John_Stepek and Marcus is at Marcus Ashworth. This episode was hosted by me, John Stepek, and it was produced by Moses Andem and Summer Sadi.